So we'll use the Power Options tools to help us illustrate our answers, our thoughts, and our comments to your questions that come in. Now, what we're looking at here is just the basic structure, the basic setup of a 14-day free trial to Power Options. If you haven't done so yet, you can go to PowerOpt.com at any time. Just put in your name and email address and start your trial. And for those of you that may be just starting off right now, we encourage you to take advantage of the 4 steps that are listed here. Access to the free quick start guide. There's a variety of free flash tutorials you can use to help you get familiar with the site right away. We do have a lot of archived webinars available for you right here, everything from the Power Options tools to option strategies, concepts, and more. And of course, anyone who's on a trial or anyone who's a subscriber to Power Options, you can schedule a free coaching session at any time. That's essentially just a 35 to 45-minute phone conversation with myself or Ernie. We will walk you through the site, answer any questions that you have, similar to what we do here on Friday afternoons, gearing this webinar to your questions and your specific options investing needs. Okay, so we had a question that came in from Don. Don says, during the opening, you mentioned open interest and volume. What is a good open interest and volume to consider on a new position? Okay, well, in general, the rule of thumb that Ernie and I suggest to investors is that regardless of the strategy that you're using, a good volume or open interest, let's just take covered calls for example, but a good volume or open interest, whether you're going weekly or whether you're going monthly, for example, but a good guideline is that, let me scroll down here to the search. The option volume in your screen should probably represent at least 5 times the number of contracts you trade on a regular basis. So if on average, I usually trade 5 contracts of a covered call, 500 shares and selling 5 calls, I'd probably look for an option volume today of at least 25 contracts. And then of course the open interest should be at least 10 times the average number that you normally trade. So I'd look for an option volume today of at least 25 contracts and an open interest of 50. Now, there is nothing wrong looking for a higher open interest. You want to look for an open interest of 100 or 1,000. That is perfectly fine. We're just saying as a rule of thumb, minimum, you should look for at least 5 times the volume of the average contracts that you trade and 10 times the open interest. Now, if you're doing leveraged spread trades, your average might be 10 contracts, 15 contracts, or 20, but I'd still hold that same average. 5 times the average number of contracts you trade in a strategy for the option volume and 10 times for the open interest as well. So that's just a good guideline to use. Will it limit out, it's a follow-up question, will looking for a high volume or high open interest limit wide bid-ask spreads? Not necessarily. Okay, let's take a look. This is a lower volume and open interest. It's the minimum that we suggest, 5 times the volume, 10 times the open interest. But let's just submit this search here. Okay, and we've got some things in here. Roku, for example. I can't pronounce that. Iovance Biotherapeutics. Iovance, I guess is what it's called. Arrowhead Research. Now, these bid-ask spreads are not bad at all. They're slightly in the money positions, but we only have a 40 bid-ask spread here on Iova, 20 cents on Roku, 20 cents on Arrowhead Research, 30 cents on Skyline Champion, 30 cents on C Limited, and 70 cents on Centene Corp. So to me, for 28-day trade, slightly in the money, that seems okay. But if you're worried that you're using a minimum volume and open interest and that your bid-ask spreads are too large, for example, you see more volatile positions that have a wider bid-ask spread, in any search you can limit that as well. Okay, so we'll scroll back down into the option criteria, and I can go ahead and look at the percent bid-ask spread. And if you're looking at a spread position, of course you'll have the percent bid-ask spread for the short option and for the long option. And now this shows the bid-ask spread of the option expressed as a percent against the natural bid price. So we're looking for a maximum, of 50%. So if I have a bid of $1, the ask price cannot be higher than $1.50, 50% above the bid price, okay? So you can also do it monetarily. We're looking for a bid-ask spread less than $1. Hey, that makes a lot of sense. That's why all of the bid-ask spreads we saw up at the top of the results were 70 cents was the highest and everything was less as well. So you can focus on the option volume and open interest, but if you want to narrow it down in any search of the 23 strategies supported, you can also limit the bid-ask spread monetarily or limit the percent bid-ask spread if you're worried that you're going to find positions that are too volatile, that have too wide of a bid-ask spread. This will greatly help you filter those out as well. Okay, so that relates to Don's question regarding open interest and volume, and will a higher open interest and volume naturally limit out a wide bid-ask spread? It probably will, not necessarily, but it probably will, but there's other screens that you can use to do that as well. Okay, all right, sorry about that. Now, let's real quick here, I got another follow-up question that came in. And it says, you'd mentioned other strategies. What other strategies can you use this in? Well, I'm pretty sure the percent bid-ask spread is available in all the strategies supported here on PowerOptions. Whenever you want to restructure the main strategies you're viewing on your tab navigation system on your trial account or on your subscription, just click on Other Strategies. And of course, here we see the selection that we have. The choices I made over here, I should say, for my available 8 tabs. And over on the left, you see all the strategies that are supported. Short straddles and strangles, naked puts, naked calls, short collars, married put, married call, long straddles and strangles, buying calls and puts, condor, butterfly, the custom spread, profit and loss chart page, covered combinations, do a covered call, but sell an out of the money put as well. Calendar calls, calendar puts, and calendar calls and calendar puts mean both diagonal spreads, where in a calendar call, it'd be buying a call that's slightly in the money and selling a call that's at or above that strike price. Also horizontals, same strike. You can screen for both in either the calendar call or the calendar put. And then of course our 4 vertical spreads are listed there as well, bear calls, bull puts, and more. All right, so those are how you can access the different strategies, and the bid-ask spread should be available in all of those strategies as well. Okay, Fernando asks, is there a utility that graphs the daily price history of a particular option similar to the price history candle chart of a stock? Fernando, I don't know one off the top of my head. Regarding the option chart. Now you can see the movement of the option right here on PowerOptions. Okay, so let's just go to a quick chain, and I'll just go to Apple. Oops, without the paren. There we go, Apple. Let's go ahead and go to the chain. Okay, and let's go ahead and just look at calls for the time being. Okay, so I'm going to pick an expiration for next week for Apple. We'll just go with the 177.50. So anytime you come across an option on a search by symbol from the option chain or even from your portfolio, go to research and go to call research. Okay, this gives you all of the data that we have for that particular call or that particular put option. Your Greeks are over here. You've got your probabilities, implied volatility, percent implied volatility range, and much more. But down below, we have a historical graph of the option prices, not in a candlestick. I don't think most investors try to look for daily chart trends using a candlestick for an option, because the option is going to move related to the stock. So if you're trying to do a daily or minute by minute or 15-minute option trade, if you look at the stock and kind of gauge based on what you use the candlestick chart for, how the stock's going to move, that could tell you whether the call or the put is going to move in a certain direction as well. But in any case here, you see just a closing graphic of the option bid, in this case, versus implied volatility. Now I'm going to stretch this here. I'm going to click and drag on one end. It's showing us the data April 11th roughly to today, 523. Option bid has been decreasing. The implied volatility has moved up a little bit, but pulled back kind of with the market there. But why this selection of only April 11th through May 23rd? The reason why is that what this graph is showing you is the data since this option, the May 31st, 7 days away, 177.5 call, has been released on the market. It's not showing you a graph of the 177.5 strike for any expiration, okay, over the course of the last 9 months, because 9 months ago the market was completely different. This is giving you the data of the bid versus implied volatility over the lifetime of this particular option. And you can change the chart as well. So you can look at option last price versus implied volatility, Black-Scholes, stock price related to option price, option volume, option bid, ask, time value, of course, or delta as well. So we can just change that there, draw the new chart, and now we'll have, of course, option bid versus the delta, which, you know, would kind of always look the same as the stock fluctuates up and down. Now, in the past, I don't think they do it anymore, but in the past, big charts did actually show some options graphics on their charting, Fernando. But you had to put in the proper symbology, and I don't even know if they were using the same symbology that we show here. This is standard across the exchanges for this particular option. We could try it real quick. Let me just take this, and we'll take out the underscore there and see if that works. I don't think it does work anymore. But see, I could go to charts and I could go to big charts, and this would be for Apple. And if I try to paste in a symbol now, instead of Apple, if I put in this that we just recorded, and let's try to take out this, well, let's try it with the underscore. It's not going to work, I believe. Yeah, I didn't think so. Like I said, I don't even know if this still works anymore. No, okay, sorry about that. So this doesn't work anymore, but they used to have it. But all that being said, Fernando, I don't know if you've checked with your broker, but your broker might have that as well. Okay, your broker might have the detailed information on charting that as well. Oh, I'm sorry. I think I'm pretty sure that was Fernando's question, but something got kind of confused here. I've got another question from Mark that seems like it's more along the same lines. There, utility of the graphs, the daily price history of a particular option, similar price. I don't know what happened there. Fernando, I might have missed your question. I think the system put your name next to Mark's question and then copied Mark's question. I'm not sure what happened there. So Fernando, if you had a different question, send it to me, because I think something just got strange there with the GoToWebinar system. I apologize. You both had the same question for some reason, and it didn't. It's very strange. Okay, that wasn't your question. Send me your other question, Fernando. That was Mark's question, but for some reason, it posted the question twice, both with Mark's name and your name as well. So that was for Mark, not Fernando. And I'll wait to see Fernando's new question. Please rewrite your question, Fernando, and send it. Maybe you two send it at the same time, and the GoToWebinar thing had a glitch in it. I'm not sure. That's very strange. Okay, so while I'm waiting for Fernando's question, we do have another one from KBB. Okay. So Mark, yeah, you can see your historical price data there, but as far as a charting technique goes, I don't know anyone who charts candlestick graphs on options. Your broker might have something. I'll keep my eyes open on that. Do some research maybe next week and see if I can find anything. Okay. So KBB's question is, we have a BA 175 strike call for June 21st expiration that was purchased at 240. But with a reduction in BABA, it is reduced drastically. Any strategy for a repair? Okay, so first let's take a look at what we've got. I'm just going to go to the custom spread tool, and I am going to put in BABA. Let's take a look at our options. You said June 21st. Okay, so let's scroll down. Here's our June 21st selection. And we've got the 175. Is that what I wrote down? Yes, 175. and we paid a price of $2.40 for it, and we see it's currently priced at around 40 cents. Okay, so we're just doing this now to see what our view is and how far out of the money we are at the current time. Okay, so all right, so here we go here, and now let me try. I'm sorry, folks. Let me try something here. There we go. Sorry about that. We know it's only worth about 40 cents right now. Okay, so we're taking a significant loss. We're probably at about a 70% loss or so on the position. The stock's at 155.30. It's 20 points away from your call strike price. Okay, now what do we have happen? What do you do typically? There's a few things we can do here, but what do we do typically when a stock falls in price? Okay, well, one of the main things we could consider is averaging down. Not always the best idea. Here's a question you have to ask for yourself first. So for KBB, do you feel that there's any settlement, any discussion, anything related to the tariffs, trade war discussion, or more, whatever's happening to the stock, do you think BABA is going to recover in price? And I don't mean just to maybe 175. I mean, do you think it's going to recover at all? We've been in a strict downslope. Everything's still pointing down. Maybe it could rebound, but I'm not seeing the MACD level off, which is one of the things I like to look for there. I like to see it level off and maybe turn, and that might be an indication. I'd like to see this start to move up a little bit as well. Here's the problem. There's no main repair you could necessarily do, straightforward repair, you could do if you think that the stock is going to continue to fall. If you think the stock's going to continue to fall, honestly, it's better to sell to close this call right now, take the loss of $2, and then look for a put option and buy a put option that matches your preference for the stock. Okay? Not everyone likes to hear that, but you've got to pick the direction. Most repairs that we would do, averaging down, converting it to a calendar, doing the stock repair, which we're going to show in a moment for you as well. But all of those are based on the stock recovering in price, moving back up. The repair doesn't work unless the stock comes back up. If you think the stock's going to stagnate or fall in price, you might as well just close this right now, take the 40 cents you can keep from it before that goes to zero, before that starts to decay or drop further. And then if you still want to trade BABA based on your new sentiment, then decide what your direction is. And if it's neutral, maybe you want to do an iron condor. If you think it's still bearish, maybe you want to buy a put. Maybe you want to buy a straddle or a strangle once you close this call because you're not sure of the direction, but you think it could rebound significantly if there's an adjustment with the easing of the tariffs, anything along that line, or even perhaps just something in this sector that you think is going to recover, but that it could continue down. Entering a strangle by buying an out-of-the-money call and out-of-the-money put for maybe July or August might be expensive, but at the same time, if it continues down and it doesn't rebound, at least you're going to make some profit on the put side. You can close that and then wait for the rebound on the call. Okay. The simplest thing to do is, simplest thing to do. Number one, you're not going to be successful on every call that you buy. Not going to be successful on every put that you buy. We're not going to be successful on every bull put credit spread or bear call credit spread. We look for a probability around 85%. We look for a success rate of 88 to 90%. Okay? Sometimes you just have to accept that this loss is going to be 10% of the losers you're expecting for your trading plan over the course of the year or 6-month period. So number one is close, take the loss, look to make it back somewhere else. No one wants to do that, but it's a possibility. Number two, the average down idea. Okay, but since we have a call, sorry, penmanship is terrible today. But since we have a call, we can't really average down. But what we might be able to do is, as I mentioned, sell this call. Okay, clear that out. And you know you've lost $2. But in averaging down, what we do is essentially roll the call down, which you might do with a covered call or what you might do with a credit spread, for example. So we're going to take the $2 loss, sell to close that June 21st for roughly 40 cents as we saw. That's maybe a little bit less, 38 to 43. It's almost right on. Okay. And now maybe we go further out to say July, maybe even August, and maybe we buy a 155. Now, of course, here's the trade-off. We're paying about $8.30 for this call. It's at a lower strike price. It's at the money, so we might even go in the money. But I also have to account for the $2 loss I just took on my original call. So essentially, I've got a 155 call at a price of $10.30. $8.30 was the bid. We took the $2 loss. So what do I have now? I have 5 times, 5 times the amount of cost basis into the option, into the position. Why that's doing that, I apologize. But at the same time now, oh, I know why it's doing it. Sorry about that. All right, let's try that again. I'm going to go to another screen in a second. I apologize. There we go. Okay. Let's just do that now. I'm going to shrink this a little bit, get it back to square one. Didn't like the zoom there. Okay, so in any case, now we've got 1030 invested in the position. Don't like the sound of that, I understand, but at the same time, what does it mean for us? It means that our new break even would be at 165.30, right? That's going to be your new break even, 165.30 essentially. So what's good about that is it's not where you are at 177.90, roughly, with what you have with the 177.5 call. Okay, so that's one option. So we could close the position again, take the loss, and move on. We could average down. As I showed you, what's that going to do? Just as you would as average the stock, it's going to increase the cost basis. You rolled down. You didn't average down. You rolled down, but it's going to increase cost, which is risky, right? Because if the stock continues to fall, you might be risking more of this 1030 than the 240 or $2 loss you have right now. But in addition to increasing the cost, you're going to lower the break even. See, on your position again, the break even was around 179.90. Now we would have reduced it to 165.30. So we got a lower break even. Okay. Number 3, you could convert it to a bear call credit spread, but I don't know if it's going to make it back to break even. And again, this is dependent on what? It's dependent on the stock staying below the new short call strike price. Okay, so what do we have? We have a long call we paid $2.40 for. In order to create the bear call credit spread or properly reduce the risk, I have to sell a lower strike call that's going to give me at least $2.40. That's break even, right? Because that's what you paid for the long. So if we're still neutral to bearish, then what I can do here, let me get my pen back. There we go. Let me clear out this call. Let's go back to our original. I'm sorry, I'm going to leave the drawings up there for now. No, I'm not. I'm going to clear that out. We'll write it back up again. Let me erase that. Okay, so we're going to start back to square one, June 21, 177.5 call, purchase price at $2.40. All right. Now, keeping in June. I'm not rolling it. I'm keeping in June. I could sell, what do we need? $2.40. We can't do it really. Oh, we can. I could sell a 160. Now, what's the problem here? The problem is you're going to have to put up $17.50 of margin, right? Because you own the 177.5 call. We're selling the 160 with the stock at about 155. So where does that leave us? It leaves us in a bear call spread at 17.5 points. So for one contract, I'd have to put up $1,775 to cover the margin. But, oh, I'm sorry, folks. In this case, sell the 160, buy the 165. We create a bear call credit spread with a credit of almost $1, 5.9%. But we're different now, aren't we? We're opposite. In this case, we're now saying that our expectation is the stock would remain above 160, because if it recovers, you could have a loss of 1652. The 1775 minus essentially the dollar net credit. Okay. Oh, I'm sorry, the 1750 minus the dollar net credit. Okay, so that's what you could do in that situation as well. Okay. All right. So let's review real quick before we go into our one. Oh, it's a 175 and not the 177.5. Okay, I'm sorry. All three still apply. And that 175 is actually looking a little bit better. You don't have the full loss there, the June. So he mentioned, KBB, excuse me, mentioned it's the 175, not the 177.5. Yeah, oh, sorry, yeah. So that's where you were talking about. I'm sorry, I clicked the wrong one. Let's clear that out. Add this back in at 240. Still a net credit, but hey, lower margin now, so you get a little bit more return if it works out as you expect, right? 7% return, still about $1 net credit, close to $1 net credit, only a $1,500 margin and $1,400 loss on the position per contract, of course. So it looks the same, but your sentiment would have changed. All right, so we have close the position and assume this is just going to be one of the losses in your trading plan. Number two, we showed that idea of rolling down, which is sort of similar to averaging down the stock price. You're going to increase the cost. You're going to sell to close yours, go out an extra month, down to lower strike prices if you think it's going to recover. You increase the risk. You increase the cost into this call. But at the same time, you lower your break even. Number three, we talked about creating the bear call spread in this case, where if you do feel the stock might be below 160 or maybe even 165, if you get 240 for that, that would put you at break even. At least you're not losing at this point. You've gotten to a position where you've covered the cost long, but as long as it stays below 165 or 160, you've turned a losing long call into a winning bear call spread. You want it to match your sentiment. And I know it's tough to choose sentiment, which is a lot of times it might be better just to close the position and move on. Take it as one of the accepted losses that you're going to take during the year or during this time period for your trading plan. Okay. Now, last but not least, a few weeks ago, last two presentations, we talked about the stock repair tool. And I believe last week, we talked about how you might be able to mimic the stock repair tool for a long call. Actually, I think we did that 2 weeks ago. We'll show it again. The stock repair tool, what it does, if I have a stock, if I had bought BABA at say 175 and bought 100 shares, what this tool attempts to do is create a ratio call spread to help you get back to break even faster. In this current situation with BABA, I just put in 175 as an example, but we see that there are no credit repairs that can be identified for June or July, August, or September. I'm sorry, it comes in as the first one comes in at September, where I could buy a 150 call for September, sell two 165s for a 45-cent net credit, and this puts my break even at 162.28 from 175. That's impressive. You don't own the stock. You own a call at the 175 strike that you paid $240 for. So your break even on this long call as you own it now is 177.40. All right, and I'm going to keep 100 shares in this case because it has to mimic the stock ownership. But again, we only see one repair to September. This doesn't work for us though, does it? Why? This is a ratio spread that it's trying to build. The details are we buy one September 150 and sell two September 165s for a total net credit of 45 cents. But it's a ratio call spread where we're short two contracts and long one. Now in a stock repair, I'm also long 100 shares. So what this equates to is a covered call with a bull call debit spread. So as the stock moves back up, what happens? my long call gains in value as the stock's moving up. So if the stock here was at 163.48, what happens? Well, we still have about a $13.92 loss on our cost basis of 177.50. But the 150 call would be worth 13.48. The two short calls would expire, and we keep the 45 cents. So now we're effectively back to break even because the value of this long call helped us get back faster. That call and the bull call debit spread that we got for a credit. Okay, that's the ratio call spread, the stock repair. But this is dangerous because you don't own a long call. This is based on expiration in September. Sorry, you don't own the stock, you own a call. So if we go to Analyze Trade, it shows me the breakdown, that profit and loss chart again, it shows me the breakdown of the stock repair. If I owned 100 shares, we don't. We don't own a September call either. We own a June 175 at a cost of 240. So what does that mean? Well, now we're in a strange situation where we're short two 165 calls, long a 150 call for September, and long a June 175. The graph doesn't really get us back to break even because we're not looking at a stock repair. Also because the call that you own right now is at a more close expiration than the one repair that could be found, or the first repair, I should say, that could be found. And the strike price is above this. So what you'd essentially have now is that bull call debit spread with a skewed calendar bear call spread. You're in an all call condor, but it's skewed because this is June and this is September. At June expiration, if this still expires, now you're in a straight ratio call spread where you're got a naked call and a bull call spread. And you don't want the stock to move back up in price. Okay, because you have infinite risk to the upside. You'd have to buy another call, and now you're taking the cost basis. So this doesn't look like a repair in this case would be possible against your long call unless you moved it out to September and tried to analyze it. Or if you rolled down that call first, and we showed that if we rolled down to the July 155, our cost basis would be 1030. I'm sorry, the long call, the 830 for that July 155 call plus the $2 loss you took on the June call would put it at 1030, and this 155 strike. So we're technically looking at a cost basis of 165.30, and we're out to July, and oh look, there's a repair. The 152.5, 157.5. That would equate to roughly 2 bull call debit spreads. And you'd get a credit of 280. So now, remember, we rolled down first to the July 155 with a cost basis of 1030. See, that gives us a repair, but it just puts us right at zero. It doesn't profit. You'd probably want, even with that credit, you'd probably want something a little bit higher, 158. Let me try this one, the 158.60 break even. Okay, so here our repair would be buying 152.5, selling 2 July 60s for 470. Okay, small net credit here, but what do we have? We've got the July. This is after rolling, selling to close years for 40 cents, rolling down to the standard July expiration. 155 call with a cost basis of 1030. So now what are you going to end up having? Well, let's see if this even gets us back to break even to July. If the stock moves back up, your new break even is 157. That's after rolling down, if that works. But your loss is still 970 if it continues down, not the 240 you currently have. It's 970 per contract. Okay? You're at 240 per contract now. But if it moves up to 160, this could put you at a gain at about 50% of your investment. What did you just do by doing this? First, you rolled down, okay, to give yourself more time and start at a lower strike price. Number 2, You implemented the repair, the stock repair, but we're forcing it kind of to be a little option repair position. And now what do you have? You have a 155, 160 bull call debit spread combined with a 152.5, 160 bull call debit spread. All right, so you're kind of double dipping here on the debit spread, but look, each one of these calls is worth 470. So you actually paid you rolled down. It would have been 1030, and then you get 470. I'm sorry, your 155 to 160 bull call spread would have been 1030 in the 470. I know that's a little complicated. I was just actually seeing if it makes sense, and it looks like it does, because if the stock's up at 160, what happens? I got to scroll up a little bit. Sorry. There we go. If the stock's trading right at 160, you get $5 back from the 155, 160 bull call spread, $7.50 back for the other. You roughly get $12.50 back in the best case scenario, with a total debit in of $9.70. Okay, so that is a potential repair, but it's in steps. You'd have to average and roll down first, then you could analyze the stock repair, get your break even back to about 157. What's the problem? The problem is this really didn't address too much of the downside. It increased your risk by 4, from 240 per contract to 970. If Alibaba continues to fall, you might double or triple your loss on this particular position. The repairs of this type, we saw that when you try to convert it to the bear call spread, you'd be having the expectation the stock would stay the same or move down and not go above 160. And this one, you're saying you feel the stock's going to recover and go back up to 160 or maybe a little bit farther to repair the long call. So what is your expectation going forward? What's happened now? Or do you have no clue on BABA and you think it's more related to what happens in the broader outside market? In which case, again, number one, if you're not sure of what it's going to do next, you have no confidence in a direction, close it now, sell to close it for about that 40 cents. Yes, you're going to take a $2 loss, but accept it as one of the losses you're going to take and look to move on. No one's going to be right 100%. Of course, then the second one we talked about, that roll down / average down. If you think the stock's going to recover, reset your position. It's going to add to your cost basis, but lower your break even. Once you do that, number 3 we'll say is you could look after rolling down, look at that stock repair / call repair to see if there's a way to fix the position. Number 4, if your sentiment is changed, you can convert it to a bear call spread just by selling that lower June call. But then your expectation would still be neutral to bearish. You don't expect it to recover. This one, you're expecting it to recover. That's your expectation. This one, you're expecting it to stay the same or move down. This one, you don't know. Let's just get out of it. Let's just close it, take our loss, and look to make back that $2 per contract loss we had on our next trade that we hope matches our bullish sentiment and the strategy that we're trading. All right. So off the top of my head, those are the first 4 that I would consider. It's really 3, but those are the first 4 you consider. If you can't find a stock repair, look at rolling down, averaging down, and then analyzing the stock repair to maybe put you in a better situation. If you're bearish now, you may be able to just sell a lower call to create the bear call, but remember, in that case, the margin went up to 1,500, not 900. The max risk was 1,500 because if it recovers and suddenly jumps back up above your original June 175 strike, you're now at max loss for that bear call, which had a $1,500 strike difference. That's $1,500 per contract. We're just using this as one contract in this situation to keep the math simple, even though it seems a little complicated when we start getting into this ratio and the stock repair. Oh, and by the way, the thing I wanted to mention, of course, you don't need any margin in this scenario. Yes, you've sold 2 contracts, but what you've done is created 2 bull call debit spreads. Even in the stock repair, you don't need any margin. That was the reason why I mentioned is that if I owned 100 shares of stock and was repairing it with the ratio spread, the stock repair, I have a covered call. I have 100 shares of stock and 1 short call, and then a bull call debit spread to help me get back to break even if it moves up as I'm expecting. Okay, so you don't need to cover any margin. But yes, doing the ratio spread by itself, if I just sold 2 and bought 1, I'd have a naked call open, which is not what I want. Okay, so, and the key here too is remember, you want the expirations to be the same. That one repair we saw that had the September repair on the position, your original June 175, doesn't make sense because come June expiration, if your 175 call expires, worthless, you have to buy another call because your other 3 options are out to September, and that time decay that we want to see to help the repair work for us isn't going to start to kick in until maybe August. Okay, so you'd have to buy a new September call at that point. Make sure that the repair is equal to or less than, but you really want it to be equal to the expiration of your call. Okay, so if you need other clarification on that going forward, I know there's a lot of numbers thrown at you, a lot of ideas on the stock repair, using a stock repair to repair an option. But remember, at any time, go to the free webinars page. When you're logged onto your account, go to Options Strategies and scroll down here. Very close. Managing your long options positions. Okay, this is from 3 years ago, but it's pretty much the same discussion we just had, but with more examples, and also the same discussion I would teach if I was teaching it next week. But it talks about management techniques for calls and puts, bought calls and puts where the underlying security moves against you, managing the position if it's already profitable, or if the underlying has stagnated and you're losing time value. So there's some other ideas you might see in that full webinar as well. Okay. Okay, Fernando has 2 questions related to the married put radioactive trading techniques. Following the rules in the blueprint, of course, our standard structure is we buy a stock, and we usually buy a 5 to 8 month out. My average is about 210, 220 days out in time. Slightly in the money put option to keep our position at single-digit risk. And then we'll use 12 different adjustments, what we call income methods, discussed fully in the blueprint, to generate income and increase profits, but also lower this initial at risk until we can potentially bulletproof the trade, meaning we have no risk to the downside and still upside profit. Standard structure, again, is buying the stock, buying a slightly in the money put option. And if I go to the default search here, you can see the criteria. So we're looking to buy a put against the stock at least 150 days out in time. Want to keep my percentage at risk between 3.5% to 9%. I don't want to go more than 20% in the money. Why? Deeper in the money you go, the lower risk you have. But at the same time, you have a lower expectancy of profit. Okay, so Fernando asks, related to this, what do you think about a synthetic long strangle? 100 shares of stock plus 2 puts in the money against an event like earnings. Well, if you have the right move, it's going to look good. If you don't have the right move, it was an extra waste of money. You might lose some time value, and even if you're going 150 days out in time, you still might experience a volatility crash. Dell Technologies, currently trading at 66.12. My structure for a married put, following the rules in the blueprint, what comes up on the search, I might buy the January 67.5 put, 238 days out in time, for $750. Now this puts me at a risk of about 8.3%. And yes, my cost basis, my net debit, or my break even, is $73.62. Why would I add $7.50, more than 10% of the underlying stock price, to buy a put? Because it's the only way to guarantee a single-digit risk. This is actually too high for me, but I'm sticking with this one for a specific reason. All right. So let's go to the profit and loss chart. This would be my standard structure for a married put, a little bit lower at midpoint at 8.1%. Again, this is still pretty high for what I would use. I like to keep my single-digit risk below about 7.5%. Personal preference. Now, what if instead of buying 1, I bought 2? Okay. Well, this does create that synthetic strangle. It increases my cost to 80.82, and that's the upper break even. But that's only, just like the married put, I didn't illustrate this, but just like the original married put, that upper break even is only at expiration. If I hold the position all the way to January expiration and I do nothing at all, and the stock was still trading below 67.50, I would have had the full loss of 8.1% on the married put. If I do the same thing here, if I hold it all the way to January expiration, make no adjustments, and the stock's still at 67.50, I'll lose $1,300 or 16.5% of the total investment. It's too high. But in this case, since we have time on our side, why did I pick Dell? Because the earnings are coming out. Oh, I could have picked Viva. They're in 5 days. Dell, the earnings are in 6 days. All right, so on 5/30, 6 days away. So on 5/31, what happens if the stock is still at 66.12? Well, see, here we get this sort of smile, don't we? Using the far outputs for the near term event, we shouldn't expect much time decay on that position. We still have 220 days out in time. So even if the stock only moves 0.5% or more, we shouldn't expect too much of a loss on this position. With a huge caveat. And we're going to take a look. A comment comes in, what about the near-term expiration? It'd be cheaper. Right. We'll take a look at that in a second. What is going to happen, assuming the stock doesn't drop 20% or 30% from poor earnings? What's going to happen after Dell releases earnings on the 30th? Well, the implied volatility is going to adjust, even for the far out option. So I need to gauge that. How do we gauge that? Like we saw earlier, I'm going to go to research. I'm going to go to option research. This will be for the put now. What am I looking at? I'm looking at this, the percent implied volatility range. You say, oh, the January option shouldn't be too affected because it's so far out in time. But earnings are coming up, and look at this number. The current IV is at 0.3368. Over the lifetime of this put, the volatility has gone between 0.2945 to 0.3460. We're in the upper 82 percentile of the implied volatility range for this particular option. Why is that important? Because when the earnings come out, I'm on Delta, I'm sorry. Let's go back to IV. Because when the earnings come out, I should expect this put option, even though it's a January put, I should expect it to revert back to closer to that lower range of around 0.25, 0.24, maybe even lower. Okay, so I'm going to expect some decline, and I'm sorry, it's 0.29. We're going to expect it to go back to about 0.29 to 0.3. That's my expectation. Now, if the stock drops 30%, it craters overnight because of extremely poor earnings, and Dell drops 30%. The volatility might stay where it is. If it goes up 15% for really powerful earnings, this is probably going to drop lower to maybe 0.25. Okay, but I would need to account for that. Doesn't seem like much, but let's see exactly how much it is. I'm going to go back to a volatility of 0.295 to the low, the worst case scenario. See how much of a difference that made? Based on the Black-Scholes pricing model, the day after the earnings on 5/31, if the implied volatility, even of these far out put options, reverts back to its low, or even goes back to about maybe even 0.3, what we would have expected for only an $18 or $20 loss if it didn't move at all becomes $192. That's not too bad for this overall position, but it's something that's important to illustrate because you have to anticipate with this kind of play, if you're playing it around earnings or a pending patent lawsuit ruling that's coming out or anything along those lines that's a known event, you have to expect a shift in the implied volatility which will affect the outcome of your far out trade. Okay? Now, how did we do that again? We went to that research tool. We looked at option research. And on the option research, we went directly to the implied volatility range, the true implied volatility range over the life of the option itself. And we can expect it to go back to the norm or maybe even lower depending on the outcome and we want to run our scenarios based on the worst case, lowest it's been over the life of the option, so we get a proper analysis of what we'd expect to see. Even if the stock stayed at the same price, we'd lose some volatility, we'd lose some of the extrinsic value we paid into. This gives us a better indication of what would happen to this trade. Still not a bad loss, and then you could continue to adjust it further based on your sentiment of the stock after that event, Fernando. It's something that can be used, but you're taking on the additional cost. And the comment came in and said, why do that? Why pay $735 at an additional $1,400 to the position to add 2 puts that are so far out in time? Let's go closer. Okay, we know that the earnings are expected around May 30th, 6 days away. So I got to go to July, and we were looking at the in the money puts, the 67.50s. Let's go right at the money. 60. It's pretty close, isn't it? We were at 66. Yeah, so we'll stay right there, 67.50. These are at 430 for 56 days because they're going to be highly affected by the earnings. This is only at 720 for 4 times the amount of time. And it's not even double the price. Okay, but that's all right. So we put in our price about 435. We're going to buy 2 July 67.50s for only 435 a piece instead of the 730. Risk is only 9.8%. Implied volatility is at 0.3605. What happens on May 31st if the stock stays right around 66.12? Hey, a loss of only $44. Based on an implied volatility of 0.36. What's going to happen on the 30th? After the earnings, volatility is going to change. To what? The event's done. Let's look at the history of our July series. It's going to take a second to come up. Let's just use the average, okay? Let's just use what we use for the July. We'll call it 0.30 even. Instead of 0.295, let's call it 0.30. The implied volatility pulls back because the event's done. 162. And you're only 18 days. Oh, I could have done June. I'm sorry, I could have done June. You're right. I could have done June. We'll look at that too. But you see the point here. Instead of a loss of 44, it goes up to 162, which was only $30 off of where the Januaries would be. And we still have 230 days of time left in the Januaries to continue to manipulate the trade as opposed to 50. You see where I'm going with this. The Junes are going to be worse. The Junes will still take us through through the earnings. But the 28-day out option is 350. Our January option, 10 times the amount of time, was only 7. Only twice the amount of cost. Or 740, so a little bit more than twice the amount of cost for 10 times the amount of time. We put this in, we buy 2. What's going to happen? Well, that natural divot is going to be lower. It's 8.1%, equal to the risk I had on the married put position. Now, sure, this gives me a huge profit to the downside if it drops about 9%, 8%. Okay, so this is the other thing I want to mention, Fernando. These synthetic strangles, or synthetic straddles, just like a real straddle, to be profitable, you still anticipate a move of about plus or minus 7% or more. Anything less than that, you're going to end up in this no zone. Not a bad loss, but it's going to require, whether you do it as a married put, whether you do it as a radioactive, a far out one, which at least gives you the time to continue to manage it, or you do it shorter term. But let's take a look here at 531 again with the June series, the cheaper cost and cheaper risk. Look at this. Day after earnings, $98. Remember, we saw $14 originally on the January, I think it was. Or maybe that was for the July. It was only $14 until we adjusted for implied volatility. And it was a small amount as well for the January. Keeping that volatility, what do we know? The volatility is going to collapse a little bit. We're going to have a volatility crush. So we've got to anticipate. I'll be nice and keep 0.30. $204. Because the time value is eroding so fast now. Yes, you paid less into it. Yes, you had a lower, higher break even and a higher, lower break even. Right? It's closer together because of less cost. But once this event happens, if you don't get that plus or minus 7 or 8% move, you're sitting on a significant portion of the loss, about half, a little bit less than half. Oh, sorry, folks. A little bit less than half of the max loss, but still significant. Going to the July, even with a volatility crush, would give you less of a loss in the case that it didn't move or only moved 1% or 2%. And going out to January, if I'm not mistaken, had the lowest loss, even with the volatility crush, because there's still a ton of time value. So what do I think about it? It's possible to use. It is possible to be profitable in either direction. But now you have to decide, based on your expectations and the movement you expect, is it worth it to go cheap and try to keep short term? Yes, you have a higher lower break even and a lower higher break even. I know that's a confusing statement. But unless you get that 7-8% move, now you've got 15 to 20 days left to go, and you're sitting on already half the loss. You could go further out in time. And what happens if nothing moves? Close one of those puts, adjust it, work on it. That's a possibility. And then last but not least, I don't want to say last but not least, but I think this is the last question I have, is also from Fernando. Fernando says, is it possible to apply the same rules of radioactive married put strategy also in an index future like S&P 500? You could do a married put on SPY, right? It mirrors the SPX percentage-wise. That's what I would suggest. You can't own shares of SPX, so you'd have to try to build it synthetically, and that may come with a different margin requirement depending on your structure. So instead of buying SPX, if you buy a call and sell a put, and then buy the put to mimic the married put, you have a calendar put spread with a long call. You might have a different margin requirement in that case. If you think SPY is going to rebound fast, SPX, the S&P 500 index, you think it's going to rebound fast, just use the ETF. Same structure you would use for the married put position. Look for your risk around 4 or 5%. It'll be closer to at the money, actually, because there's less volatility. Go 150 days out. You're just trading SPY instead of SPX, but you'll see the same percentage gains. SPX moves up 10% in the next 20 to 40 days. That's not a recommendation or suggestion or my outlook, but if it does, guess what? SPY is moving up 10% in the next 24 days, or pretty much close to it. It might be 9.8%. Okay, so to answer your question without looking at it, you could build a synthetic stock on SPX and then do the married put, but your margin requirements are going to be different, right? Because it's not a married put anymore. It's a calendar put with a long call. You short a put and buy a call with the same expiration and buy a far out put to protect it, to sort of create the structure you want. You sort of created a synthetic married put. Over the last, I'd say, 10 years or so since I've been working with radioactive trading, maybe 11 really. It's closer to 12, but it's 11 and a half roughly that I've been working with radioactive trading and trading this in my own account. I've had maybe 8 or 9 people who diligently tried to go out on their own and instead of doing the married put position, build the synthetic. Do a synthetic long stock and add the put instead of putting up the capital to do the married put, but they have a margin requirement. If I'm remembering correctly, of those 8 or 9 people that did it, 7 to 8 of them abandoned that approach within the first 30 days and started trading just the married put by itself and did so for a few years. And a couple of them still are trading it, and I hear from them on a regular basis. 1 or 2 of them stayed with a synthetic or changed strategies later on. So the synthetic doesn't always work out as well as you want, depending on how you structure it. And it's not something I do. It's not something I would recommend. If you want to trade a married put on SPY, trade the radioactive strategy on SPX, I would just do it on SPY. You want to do it on NDX, just use QQQ. All right, you can buy the shares. You can treat it exactly like a married put position as taught in the blueprint and the radioactive trading techniques. Don't get involved with the synthetics on the index unless you feel there's some other advantage, such as a tax advantage, which you can get with like iron condors on the broad-based index, or the benefit of European expiration styles, as opposed to American expiration, where you can be assigned at any time. That's when you would stick with the index if you think that's favorable for you. But it's a different structure trying to do it synthetically because the margin plays into it. And keep in mind, you're not in a long stock with a put position. You're not in a married put. You're in a synthetic, which technically means you're in a calendar put with a long call. Okay, so you got to keep that in mind when you're looking to do a synthetic on an index. And are you getting the benefits of some of those other aspects of trading an index that you can't get just by using the ETF, doing the radioactive trade on SPY? All right. Okay, ladies and gentlemen, we are at 5:36 p.m. Eastern time. I should say it that way. I don't see any other questions come in. If anyone has any last-minute questions, feel free to go ahead and send those in. But I just wanted to remind everyone, of course, here that there we go, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance, and options knowledge. Any stocks such as Dell, Apple, we showed a little bit, and we did the BABA management technique there for KBB, are not direct recommendations or suggestions by me personally. Right? They were examples used based on the questions that came in and what we could have found in the search to show, for example, Fernando's idea of doing a married put position with 2-to-1 ratio to create the synthetic straddle around earnings. Options do involve risk, may not be suitable for all investors as well. Okay, I did have a last-minute question come in. It's from TraderRick, I believe. Yeah, TraderRick R. Delta neutral works on credit spreads. No. A credit spread by definition, a standard credit spread, cannot be delta neutral. Okay, if I'm telling you to set up a structure for a proper bull put credit spread or a bear call credit spread, you are not delta neutral at all. It's just you can't be. Otherwise, it wouldn't be a credit. A delta neutral almost implies no credit. And if you do get a credit on delta neutral, you're dealing with calls and puts together. Okay, so I'm going to pause that and just take a look here. Let me go back to power options very quickly. All right. And okay, bull put credit spread. I'm just going to go into the search. What I would do if I'm opening a bull put credit spread on Tuesday, because remember the markets are closed on Monday. So following my trading plan for the weekly bull put credit spreads, I usually open 2 to 3 bull puts on Monday following this criteria. Can't be open till Tuesday, because the market will be closed on Monday. I'm just going to take Shopify here, okay? And naturally, to open the position, to open a true credit spread with a stock at $275, I might sell a June 250 for $1.80. I'm sorry, that's not the right price. And buy a June 247.5 for a credit of 43 cents at midpoint. Okay, so I'd be looking at 198 midpoint for selling a 250, buying the 247.5, 250 apart for 155. Okay, which means that I get a credit of about 42 cents and a 20.2% return. Now, obviously, I know this isn't what you were asking, but a credit spread by definition cannot be delta neutral. A true vertical credit spread can't be delta neutral. We know that. This is a higher delta than this, or a higher negative delta than this, because it's closer to at the money. Let's just take a look at what these are. All right, so go to research. I'm just going to go to the option chain for June 7th. That's what this expiration was, the June 7th. And we were looking at the, I'm very sorry, folks, the 250, 247.5. Okay, so I'm going to go to a medium chain. 250, 247.5. All right, so I'm at 0.9, I'm sorry, 0.11 to negative 0.9. How do I counter this? What is this? This is the bought one, where if the put option drops a point, I should expect to gain 9 cents, and I'd be losing 11 cents here. So to make this a delta neutral, what do I need? I need a long put with a delta of 0.02. And that is the 232.5. So what did if I buy this option, the same expiration, 232.5, and I own the 247.5 with a 9 delta. Stock drops 1 point. I should gain 11 cents on these two, which would put me counter to the 11-cent loss I take on the 250 put that I sold. Right? So 232.50. I need to buy that for the June 7th expiration. Oh, not the call. Sorry. We don't want the call. I want the put. And you saw the price there. All right, so I need to buy this. So I have a negative 0.2 delta here, negative 0.9 here, and I sold this, which makes this an 11 delta. Now I'm at delta neutral. What's the point of this trade? Okay, not all of them will look like this, but this is always my issue. If I was doing a bull put spread, I was expecting the stock to move up in price. It was going to stay the same or move up. It's a 275. I'm doing the 250s. It stays the same or moves up in price. I make that profit. We saw about 20.2%. By complicating things and saying, oh, I need to be delta neutral in case it goes against me, what you've done is create a position that will have a small loss of about, I don't know, 20 cents, 30 cents if the stock stays anywhere above 255, a larger loss of 280 if the stock's trading between the two strike prices, 232.5 and the 247.5. Oh, but you do have a huge maximum profit assuming the stock tanks this way. Right. Okay. And so now here we are in this position, but what else do we have to pay attention to? If you're trading delta neutral, if the stock does move down 1 point, okay, you've countered your delta. But now what were your gammas? Now you got to look at that and you've got to say, okay, well, in this case, now that that happened, here I am, this adjusted to a negative 0.14 delta. This went up to from 0.09 to let's say 0.1, and this went up from 0.2 to 0.3. Oh, what? Oops, not delta neutral anymore. Now I've got to roll some legs somewhere to get this combination back to delta neutral. And then the stock pulls back up 50 cents. Oh, I'm out of delta neutral. I've got to move one of these options a different direction, up or down, change the sell to a buy to get delta neutral again. It can drive you crazy trying to do that, in my opinion. Delta neutral is not something for me. It's not something I do personally. If you could possibly have a structure by going closer maybe to at the money where you'd still end up with a delta neutral position from the bull put spread that maybe looks something like this, where you still had a small profit of 20 cents in this case if it moved up, only probably a loss, so I say only of maybe 210 here if it drops, and then you might have infinite gains if it continues down. Remember, your whole research was the stock was neutral to bullish to begin with. Yeah, you're not going to be right all the time, but in this case, you're taking an extreme amount off of the potential profit in this case. And I don't know if it's going to be worth it long term. And you said, so you use delta neutral if the price is against your CR? No. I personally don't, honestly. And if I get a position that comes up, I'm in a bull put credit spread and it moves against me, I've got a webinar that's 8 ways to manage the position based on your sentiment going forward. Sort of what we showed KBBB with the ratio spread. I added an extra B, KBB, with that ratio spread. I don't personally use delta neutral in my adjustments for any strategy. Calendar spreads, bull put credit spreads, bear call credit spreads, married puts even. I don't look to be delta neutral as a hedge. Okay, I look for the graph and I look for my expectations, what matches my preference going forward. If I was in that original bull put and the trade started to move against me, I would do different management techniques. You know, we talk about those in one of the webinars. I might just roll this down 1 strike. I may roll this out to convert my bull to a bear. I may move the spread down. I may create an iron condor position, which is not delta neutral exactly. It's more kind of delta opposed. It's a weird statement, but it's more delta opposed to do this as a hedge to bump up the profit if I'm not being too threatened, but at the same time, get a better lower break even, but now I'd also have an upper break even as well. This is me personally. I don't like to do this delta neutral because of the reason I just mentioned. That when I tried to follow, this probably would have been 2006 or 2007. You know, my job, of course, has been to know what's going on in the market, know what competition's doing, know what other fine options educators are teaching as well. Not to copy it, but to understand what they're doing and see if I can incorporate it in my style and incorporate it to our investors, not copying it, but saying, hey, here's an idea from Chuck Hughes. Here's an idea I heard from Tastyworks. Some of these Friday sessions, someone says, hey, I showed this idea from Tastyworks about doing this strategy. What do you think of it? I'll look at it. And I'm not going to denounce it or say mine are better. We're going to look at the pros and cons for that investment and discuss it with him. Those guys at Tastyworks are very smart. They're very educated. They're very good at what they do. Okay. But every time I came across a options educator or a strategy for delta neutral trading, TraderRick, what I found is that if I had kept with it over the course of a 6 to 8 month period, I would have multiplied my commissions by about 300 to 400%. Because in order to stay delta neutral, you're constantly moving and you're constantly adjusting. Are you canceling out a lot of the risk that you might have of just buying a call, as we saw in the beginning, where it dropped and it went against you? Sure. But you're not seeing this. You're seeing something that might be like this, where this is a very limited profit here, potentially a limited profit on this end, wide range in here, and say, oh, what I'm lowering all of my risks and I'm getting a good success rate, but instead of making 40 or 50 cents at an 88% success rate, you're making 10 cents at maybe a 91% success rate with 6 to 7 to 8 times the commission costs. So yeah, and you're right. As I mentioned with KBB, TraderRick just mentioned that, yes, if the price turn around and we have to do reverse again, frustration, I understand. And that's the problem with some of the straightforward management techniques. What we saw with that converting KBB's long call into a bear call credit spread position, if it whipsaws back up, now we've got to manage that one, and we did increase the potential risk. The risk of averaging down first and doing the repairs, that we increase the cost to lower the break even. If it continues down, if it goes back up, we're great. But if it falls back down, it continues down. In the case of BABA, we're losing more money. It is frustrating, but I've also found it to be this way. Now, Mark sort of complements my statement here with something that he added to our conversation here, the recent one. He says, Mark says, there's a nice term for the dip on that last answer. And what he's referring to here is this little dip that comes in this wide area. And if I had moved it, closer to at the money, it would have been here. But in any case, this dip, the Big Dipper, his term for it is the sea or lake of death. Negative outcome if the stock sits or hits in the higher probability areas. Now, as I mentioned, you probably get a better structure, a credit. This one here, this delta neutral bull put credit spread we created by adding that extra 232.5 put. This is delta neutral, but it was at a loss. If I did it more at the money, as Mark's mentioning, we'd see something like this, and then it'd go like that. Maybe not as wide. So his term is the lake of death, because again, why? This might only be a 10 or 20 cent profit. This here is going to be 10 to 20 times that profit. And this max expectation you don't expect to see unless something major comes out and you see a 20%, 15% drop on the stock. So let me redraw this so it's more clear. This is what he's talking about, the lake or the sea of death. You've got a position here. You did it more at the money, and it does this. And this is 10 to 20 cents profit over a long trading horizon. And I'm not talking about rolling, adjusting, and maneuvering. Over a long time horizon, what would you expect? Well, with what they might call a probability cone or area, you'd probably expect that 60 to 70% of the time you're in here. Okay? 10% of the time you might be up here. 15% of the time you'll be here. 10% of the time you'll be here. That's more than 100, isn't it? It's an 80, 90. Yes, I'm up to about 105. But maybe it's more like 5% you're up here and 5% you're in here. But you see long term what you're getting 7 times 10, maybe 8 times 10, but those 1 or 2 times it goes down to the 10, or you're losing 100 or 200. Now, of course, you're going to be managing it, but that's why he calls it the lake of death, because slowly and surely you find yourself more and more here, and you're not getting enough on these ones to win long term. Okay. But yeah, that's the negative outcome. If the stock sits at the loss part of the profit and loss chart, and it's wiping out more of those minimized gains you took to try to be delta neutral. Anyone who watches this archive later, anyone who watches this on YouTube, made it this far into the presentation, you have comments, detractions, discussion you want to enter on what I just mentioned of my thoughts on the delta neutral, hey, throw them up there in the comments. Email me to support@powerop.com. I'd love to hear them. I have just never seen this work for me personally, following other investors who were doing this in 2006, 2007, revisited it in 2012 because more questions came in. It's not part of my personal repertoire. I'm sure some of you out there are trading delta neutral more or less, and you've been successful with it. I'd love to hear your stories because it didn't seem to work out for me long term. And I was making more money doing other strategies. As I mentioned, the bull puts, the married puts, standard collars, diagonal calendar spreads with proper trade structure and the proper management techniques in place already for when it does go against you, that I didn't need the delta neutral structure or the delta neutral trading approach to limit losses or control losses. I already had that in my trading plan. And of course, those trading plans I'm talking about are mostly available on the webinars and Power Options as is. But hey, I know there are people out there who make more money than me. I'm never going to say I'm the best trader ever. I'm never going to say I'm the best trader you guys will ever hear on a webinar. So if someone does have good stories, positive stories, benefits of how delta neutral trading turned around your portfolio and made you a better trader, I would love to hear them. Send me an email, mention them in the comments, and we'll take it from there. All right. Just a reminder, everyone, of course, wrapping up again. If you haven't tested out Power Options, remember at any time you can take a 14-day free trial with no credit card required. Just go to powerop.com, put in your name and email address. And then you'll just hit start my trial. You'll get access to the site for 14 days. As we mentioned a couple times today, for the managing your long call position, as well as some of the discussion on the criteria to use, that was in the options concept. We talked about open interest and volume for Don at the beginning. You can get other free education. As always, just go to the blog.powerop.com. On the webinars page, powerop.com/webinars.asp. You can always check us out on YouTube as well. If you think of any other questions over this extended weekend, one last reminder, markets closed on Monday. Send me an email to support@powerop.com or support@radioactivetrading.com. You could also call us during market hours at 302-992-7971. Trial members and subscribers, remember, you can always schedule a coaching session to talk with Ernie or myself. Ladies and gentlemen, thank you once again for joining me. Have a fantastic holiday weekend, extended weekend, Memorial Day weekend, and I hope to see you all next week at some of our other presentations or just maybe on a coaching session. Take care, everyone. Good night.